Good day to you all. I'm Cadet Manyakap. I'm here to present the Group 3. So our topic for today is stocks, bond, and mutual funds. Mutual fund. So what is stock? So companies can raise money either by borrowing or selling shares of stock to finance operations, plan plan expansions, and others. If the company raised money by means of selling shares of ownership, these ownership shares are called stocks. So let me give you a one scenario of stocks. So Liza is a young investor is thinking of buying the shares of ABC Corporation. She expects the company will pay at least 5 pesos dividend next year, and dividends are expected to grow at least a 4% rate annually. She requires a 10% return of her investment. So she wants to know the fair price of the stock. So to get the fair price of the stock, we need the formula of the stock, which is P, or stands for price, equals to dividend over rate of return minus growth rate. So here's the solution of the scenario. So P equals to dividend 5 pesos over 10% minus 4%. So let's calculate it first, the growth rate and rate of return. So the answer is 6%. So calculate the dividend and the growth rate. So this 5 pesos minus 5 pesos divided by 6%, it's equals to 83.33 pesos. So the answer should be Liza should pay at least 83.33 pesos or less for the stock to meet her 10% rate of expectation.
What is bond? A bond is a type of investment that represents a loan made by investors to a borrower, typically a corporation, government, or other organization. Here's the example. Issuer, the entity borrowing the money, government or money, investors, the persons or institution lending the money, buying the bond, principal, face value, the amount of issuer agreed to repay the maturity, interest, the regular payments the issuer makes to the bondholder, usually semi-annually. Maturity date, the date when the issuer pays the principal.
Mark, a conservative investor, is looking at a 1,000 face value bond from the company. The bond paid 8% annual interest for 5 years, and similar market bonds 6% interest. He wants to know that how much he should pay of the bond today.
So to solve the scenario of bond, we need to find the formula first, which is P equals to P equals to summation of N, which is the years, and over time equals to 1. And C, which is the annual coupon, over 1 plus R, or market rate, to the power of T, or time, plus F, or face value, over 1 plus R, or market rate, to the power of N, or the years. So to solve the scenario of bond, we need to do the step 1 first. So the step 1 is to present the value of coupons. So as you can see in the PPT, there's how to get the present the value of the coupons. So in step 2, present the value of face value. So as you can see again in the PPT, there's the solution on how to get to present the value of the face value. And lastly, the step 3, add them together. So if you add them together, you get the 1000 and 1084.25 cents. So Mark should pay at least 1084.25 cents for the bond to earn at least 6% of return.
What is mutual bond? A mutual bond is a type of investment where many people pool their money together to invest in a diversified portfolio of stocks, bonds, or other assets. It is managed by a professional fund manager who decides how to invest the money to meet the fund's objectives, growth, income, stability, etc. So the scenario is Jane, a college student, invested in a mutual fund. She wants to check how much one share or unit the fund is worth today. Total assets of fund 50 million pesos. Total liabilities 2 million Philippine pesos. Number of outstanding shares 4,800,000 shares. So the formula for calculating net asset value equals total assets minus total liabilities over number of outstanding shares. So the answer is the net asset value per share is 10 peso. This means if Jane owns 100 shares, her investment is worth. The calculation for Jane's specific invested worth is implied but not explicitly shown, though it would be 100 shares times 10 share equals 1,000.
So again, we are group 3. Thank you for listening, everyone.